Know yourself and don't be afraid to lean into the stuff that resonates with you rather than the stuff that other people tell you is amazing.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth in life starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth in life so you can give more all of it away to help MVPs. My name is Brett Swartz, and every episode we're joined by some of the world's top millionaires, billionaires, and entrepreneurs, where they share their secrets with us so we can scale, build, and leave even a better legacy. So I'm excited about our next guest. She's out of the state of New York, and she's on a mission to help turn the finance and insider world kind of upside down with the insurance industry. She brings a dynamic and quantitative approach to insurance-based wealth planning and risk management. She's a former Goldman Sachs investment banker and hedge fund investor. She's a part of an elite team managing a multi-billion-dollar portfolio, developing expertise in capital markets, tax-efficient investing, and financial regulation, and so much more. Please welcome to the show with me, Wallis, Tsai. Wallis, how we doing?
Great. Thanks so much for having me. Excited to be here.
Yeah, grateful to have you as well. And for our listeners getting to know for the first time, maybe just give a little bit more about your story and your current focus.
Sure thing. So I grew up in Cleveland, Ohio, and I took a year off after college to teach English on China on a fellowship. And then I came back to New York City, which was obviously a big cultural adjustment, both coming from Ohio and having spent the year in China. And I started working at Goldman Sachs, which is a big New York City investment bank. And I was working long hours, developed my love of Excel spreadsheets there, and started learning the ins and outs of the financial services business. And I had a focus on banks, insurance companies, asset managers. So as I and insurance companies. And so I started learning how these companies work, how they make money, how the industries function. And I was working hard at my job and doing well at Goldman, but the thing I was really excited about was actually a side project that I would do sort of, here and there when I had snippets of time, which was reviewing personal financial choices for friends and colleagues who had been given these pitches about stuff they should invest their money in. And I was blown away by how often the advice they were getting was just really not great. It was either pretty bad or just not optimal. It was maybe not a terrible idea, but could have been better if you were really thinking about what is the best thing available for this person in the market. And I started doing that on the side, and that really grew into my passion. And so I decided to make that my full-time focus when I started Above Board. And I co-founded Above Board with Nancy, who's a software developer. She has brought the tech expertise, and I'm the finance person. And so together we've built this company that seeks to take a tech forward analysis and really the truth focused approach to insurance. And we picked insurance because I feel like it's one of the areas of financial services where it can do so much good when it's used correctly. And yet at the same time, who among us hasn't sat through an absolutely miserable insurance meeting? I think that's a very popular lived human experience where it's
Yeah,
just like, oh my God, this feels terrible. And you may or may not know why exactly it feels terrible, but it just kind of does. And I had sat through a few of those meetings myself, and I was just like, man, this could be so much better because the products themselves used correctly can do a ton of good, but so often suboptimal outcomes end up reigning supreme. So how do we fix this problem?
absolutely. That's what we're going to be talking about today. If you want to connect with Wallis right now, you can go to aboveboardfinancial.com /billions, aboveboardfinancial.com /billions. And yeah, that's really interesting, right? So you've had a chance to be at Goldman Sachs, had a chance to see, poor financial pitches, maybe, really good ones, right? And it's probably trained by the best of the best at Goldman Sachs. And so what's the number one secret, I guess, to cutting out, you call it the no BS insurance kind of either mindset or framework? Let's start with that and we'll work our way through.
Yeah, sure thing. So the way that we approach insurance in some ways incorporates some of the skills that I learned at Goldman Sachs, and in particular, thinking about risk and working in the hedge fund, right? Where you're not just trying for a significant upside return, but also thinking about downside risk and how do you manage the fact that nobody has a crystal ball with which to see the future. And so the approach that we use at Above Board is to be crystal clear about what we know and what we don't know, and then think through a range of reasonable scenarios and really own the details, right? I think something that often gets overlooked and is the reason that sometimes insurance policies go really wrong for people is that if you don't own the details and really know how these policies work, some of the policies, and in particular here, I'm talking about permanent insurance for the most part. So things like whole life, variable life, universal life. I'm not as much talking about term because that tends to be a simpler product. But if you don't own the details, then you can end up with some significant mistakes. And so we're laser focused on reading the documents closely, right? Like one of the things I learned in the 2008 financial crisis was that, you know, the value of understanding the documents is huge because what happened with the mortgage crisis is that a lot of people had not read the documents or at least not understood them and then were surprised later by what ended up being totally possible to have happen. And so at Above Board, we read the documents closely, we understand these policies, and we're very rigorous in the analysis of what these products are. And then we're also honest with our clients about what they can qualify for. With insurance, there's a tiered pricing system based on somebody's health and lifestyle. So if you've previously survived a cancer journey, or if you are a very hardcore skydiver, right? These are things that can impact your pricing. And sometimes what happens in the industry is that everyone gets quoted the second best or the best rate. And we take a different approach where we try to be really focused again on owning the details and getting it right and understanding, well, what would this client really qualify for? Like, what's really in their best interest? And then we have a very rigorous quantitative process that we run in the background. We are happy to discuss it in detail with clients who like that type of thing, but also it's not necessary for clients where the thought of a spreadsheet makes you recoil in horror. So
Yeah.
we're not gonna force the spreadsheet on anyone, but for every client, we do a very rigorous analysis when they're looking at these more sophisticated strategies, and our efficiency is enhanced by a lot of the tools my co-founder Nancy has built. And we want to get to the right answer. And for some people, the right answer is, hey, insurance is not the best tool for the job.
Mm-hmm.
But for a lot of people, it is. And so I think that when you have a process where it is intellectually honest and it is possible to conclude that insurance is good as well as that insurance is bad for a particular client, that's a process you can trust.
Mm-hmm.
Because there's a thoughtful framework that's based in facts rather than just tiresome repetition of the same old sales lines.
Got it. What's the number one mistake we talking kind of before the show? You've made a million, 2, 5, 10 and above. And maybe you've had some old insurance in the past, some straight term insurance that was based upon your lifestyle that was lower. And all of a sudden you're like, wow, I've massively increased my net worth. And, give us a more holistic and maybe a more appropriate insurance strategy versus some of maybe the older ones that people are stuck in.
Sure thing. So I would say the main thing to do that will help you always stay in a good place is to review your insurance or have a professional, we do this for a lot of clients, like review your insurance coverage based on where you are today. Because as your situation evolves, or if sometimes it's a single event that massively changes your situation, such as the exit of a business or a really fantastic year or vesting of a big slug of something you own, right? So there are these events that can really change your situation materially. And being aware of what that implies about what might change in terms of either your insurance needs or just ideas that previously would not have been a good idea can become a good idea if your situation is significantly different today than it was 3, 5 years ago. So I think regular updates is probably like your best practice as a person or a family
Mhm.
to just make sure that you're keeping up with where you are now.
Got it. Let's get practical on that, right? So like, let's say you had the term insurance for $1 to $3 million, and this was 10 years ago, and it's a fix for 20, but now your net worth is 5 or 10 or $15 million now, and you're going, okay, well, if something happens, like that's the 1 to 3 is not going to cover it anymore. Is that what we're talking about here? Are you talking to increase your term? Or are you talking about more like a whole life policy with flexibility to borrow against it? Walk us through just a general framework of what you mean by that.
Sure thing. So, definitely disaster mitigation is very important. And we want to always make sure that our clients feel okay about where they're positioned, where if God forbid something happened to them or their spouse, whether it took the form of premature death or being sick and not able to work, that the family or the person's loved ones would be all right. And I think sometimes people don't appreciate just how much more frequent those types of health surprises become as one moves through the years. But you want to make sure that disaster is off the table. That's usually a fairly quick and efficient exercise, just in terms of updating the coverage calculation. We do free reviews of workplace plans to make sure that people aren't going to be surprised negatively if, God forbid, they do get that news that the colonoscopy or the mammogram didn't go well or didn't come back the way you always hope. And we try to take disaster off the table. Now, after that, it's also frankly more fun to think about the opportunities for tax advantaged wealth accumulation, because generally thinking about what's thankfully the base case, right, which is that you're going to likely live many more decades and you'll want to spend and enjoy your money and you want to watch your kids grow up. Maybe if you're like me, like you hope at some point one or both of them will choose to make some grandkids. Like I'm already excited about this and my kids are still in grade school, but I see what a joy my children are to my parents and my in-laws. And it's just, those are the fun things to think about, right? And so when you get into that echelon you're talking about where you have multiple millions, that's where you can do some very interesting planning around tax advantaged retirement savings and also thinking about leaving something that outlives you, whether it's a family trust or a meaningful contribution to a charitable cause or both. There are some really interesting planning techniques you can use to maximize your money that you enjoy during your lifetime or that your loved ones enjoy during their
Got
lifetime.
it. Got it. And by the way, we're speaking with Wallis Tsai. And by the way, you can you pronounce Tsai like I'm saying it, but it's spelled Tsai. And you can find Wallis Tsai by going to abovefinancial.com/billions. Aboveboardfinancial.com/billions. Speaking of tax advantages, right? One of the biggest challenges we have found with the high capacity families we work with is they're exiting a massive business, huge Bitcoin positions, stock, real estate. They have huge capital gains taxes. You're in New York. I'm originally from California. And this is just like a daunting thing where, 20, 30, 40, 50% can be wiped out by capital gains tax, depreciation, recapture, and or they're facing estate tax. They actually want to be doing more insurance, but a lot of their cash is tied up in illiquid assets, right? It's not cash flowing as much. So we built a strategy that allows them to defer capital gains taxes and then diversify into insurance plans or stocks or real estate or debt and diversify their entire portfolio. I'm curious, is there a creative way that you have found to tax defer large, multi-million-dollar exits, defer the tax and then go into an insurance policy?
So tell me if this is responsive to the question that you're asking, but what we found is that having a irrevocable trust where the gifts are going to be getting those assets out of the client's estate. And then, really importantly, right, the value of that structure really comes from the future appreciation, right? And so, if you're working with a client where they have an asset today and they expect it to go up in value in the future, the sooner that you can make a gift of that asset into the trust, and oftentimes the beneficiaries of that trust are children or grandchildren or other loved ones. There might be participation by a nonprofit or a charitable contribution involved in that structure too. But you can gift, you don't have to only gift cash assets to the trust. You can also gift other assets to the trust, which I'm sure you see all the time in your work with clients. And in particular, when you work with qualified attorneys and tax accountants, which, to be clear, we're the independent insurance brokerage piece of the puzzle. We are not a lawyer or a tax advisor. So I'm just sort of sharing some high level things that we see because we're adjacent to it in our role as an insurance broker. But you can do some creative, interesting things around, what is the right moment in time to value these assets? So, for example, if a client has a commercial real estate property, and let's say that a significant tenant has just declared bankruptcy and the market is going through a bit of a downturn, right? You can do a completely fair and appropriate valuation that will result in a valuation of that building that probably doesn't represent what you think it has the potential to be worth 20 years from now. And so sometimes taking advantage of those moments, and I'd be curious, Brett, if you see this happening with the CRE market too, but taking advantage of those downturns, those things where all else equal, you'd be like, oh man, this is terrible news, right? Getting that letter that your tenant your anchor tenant is filing for bankruptcy. Like that's not a good feeling. That's not a good moment. But then there can be this silver lining where if you make the gift of an asset that's struggling, but you believe, okay, I think that we're going to eventually make it through this. It's going to take some effort and maybe some luck, but fundamentally, I think I feel good about the long-term value of this. Then moving that asset in a moment in time where it's advantageous can be really smart because you get all that future appreciation out of your own estate. Right now, the difference between the gift and the future value lives in the trust, not in your own estate. And then oftentimes those assets that can get put into a trust that aren't cash can themselves be cash flowing, right? And so what's interesting is about pairing life insurance with, I'll call them like real assets inside a trust, is that the life insurance policy can either receive cash that's thrown off by the asset, where you're just kind of like, okay, like what am I going to invest this cash in to keep the return going? Or it could sometimes be a source of financing for other transactions that you might want to empower your trustee to do, right? Because with a lot of these permanent insurance policies, you have something called cash value, which is the value that can be accessed while the insured person is still alive. And
Yeah, got it. So a couple things. So yes, I love those strategies when you want to keep the asset, right? And you can gift it and gift it over time and gift it at a discounted value. And if it's illiquid, you get at least, 20, maybe 30% off of the value, all of those things. So what we're seeing is the 84 to $100 trillion of the baby boomers transferring these big businesses, big real estate, and they're tired of the toilets, the trash, the termites, the rent control, the regulation. And they feel like a lot of their wealth is locked in these very low basis properties that they otherwise would want to harvest to go reinvest and maybe even get bigger life insurance policies, but it's tied to this. And so they can only give so much per year. And so we have a way where without any gifting, life insurance or charity required, it needs to sell. So you need to have a buyer buy the property for 100 million or 50 million or 10 million, whatever it is, but we can remove it outside of the taxable state into an irrevocable trust. And then that itself can go fund a life insurance policy or fund another business venture or and increase the cash on cash return. And so it's combining, I think, the best of both worlds to be able to exit and be completely removed from it, because that's what we found that a lot of our clients, they want what's called truly passive income. We define it as no shoes, no shirt, no problem, where they're Kenny Chesney on the beach, just playing it with a guitar. And they're collecting this completely passive income. It's the fourth quadrant in the rich dad, poor dad quadrant. And they're well diversified. They're debt free. They have insurance. They have, a balanced portfolio of liquid, stocks, bonds, mutual funds. They have real estate, private equity, passive real estate. They can also be entrepreneurial, but time is on their side. They don't have to do any rush 1031 exchanges, or they don't have to stay in a Delaware statutory trust to stay, in the same like kind investment real estate. And it's transformational for families. And so that's the piece where I think they really want to exit. We believe that truly passive income is to our clients' freedom and impact as compounding interest is to their money. And they're like, I've built it. Now I actually want to focus on other parts of my family mission, vision, values, right? And our legacy. And it doesn't necessarily mean holding on to these assets. And a great example is this last 3 years. I mean, we've seen interest rates double. And we always see cap rates, especially for multifamily properties that are in this negative arbitrage situation. And we knew the market was red hot. We knew it was an all-time high. Like, we knew it, but most people didn't have a way to get out without having to then like-kind 45-day 180 buy in this 1031 rush market. And so, yeah, we basically build these plans to defer and not have to do a 1031. And so it sounds like the version you guys have is hold the property, gift the property. Is that what you're saying? You can't actually sell the asset, or can you?
so you can gift it or you can sell it to the trust. I've seen different structures used. I mean, usually that decision is made outside of like the insurance piece of the puzzle, which is where we focus our efforts. But I mean, the structure that you're describing sounds very interesting. Like, we haven't talked in detail about it, but would definitely like to follow up offline and learn more about the details of that particular structure you've been doing. But I think the idea of getting an asset, a real asset, into a trust and then either migrating its value to insurance over time or just having the insurance sit alongside the asset if you continue to run it, are both strategies that can work. And having that tax advantaged box that is insurance can just be a useful tool to have when you're empowering the trustees to make choices about how to optimize value.
Awesome. If people want to learn more about all of this, you can go to capitalgainstaxsolutions.com, where we build capital gains tax exit plans. That's capitalgainstaxsolutions.com. Works for Bitcoin, businesses, real estate, any asset of any kind. You no longer have to do the 1031 exchange ever again, and it gives you the ability to diversify in working with folks like Wallis, Tsai into insurance or other assets if you're choosing. Just go to capitalgainstaxsolutions.com. So we've talked about risk mitigation, disaster mitigation, right? We've talked about opportunities for tax advantages. We kind of geeked out on that. Thank you for geeking out on that with me. And let's go into whole life insurance. So what's the number one secret here for someone who's like, you know what, I'm worth 5, 10, 100 million bucks. I've only made my money in real estate and business. Of course, I have my term insurance, but now I want to get a little stepped up here and start to, put away 100 to 300,000 a year into this long-term whole life insurance policy. I'm still trying to crack this code. I've heard so many pitches, and you mentioned this, and my head always just goes, but if I go make this and I just keep on my term, and then I kind of go in a circle, and then just give us break it down. If you're sitting down with someone who's got a high risk tolerance, who's got 10 million plus of wealth, and only has term insurance, and you're going to say, here are the top 3 reasons why you want to start a whole life insurance today. And let's say they're 40 years old and they're in good health and all of those cool things.
Yeah. So for somebody where the pricing would not be a barrier, right? You said good health. I would say that the odds of insurance being an attractive component of somebody's overall strategy for the scenario you're describing are really high, right? Unless that person is like a professional knife thrower, it's probably going to work out very well. And so I would say that for that demographic, right, one of the most important things to do as the consumer, and then one of the things we focus on as the independent broker, is making sure that our clients really kind of understand what they own. Because when you move out of the term universe, you're looking at permanent insurance. And within permanent insurance, you have a lot of different flavors. In fact, whole life is often used to describe any type of permanent life insurance, when in fact it's only one particular flavor. So if ice cream is permanent life insurance, whole life is like saying mint chocolate chip. And then you've also got universal life, which maybe is strawberry, and then variable life, which might be chocolate. And so making sure that people are aware of what they're thinking about getting and really picking the best tool for the job. I think that's one of the challenges that we see people face elsewhere, where if they're talking to somebody who represents a company that sells a ton of whole life, and that's really the focus, they often end up buying whole life because that's what the person wanted to talk to them about. Whereas, we work with over 30 carriers and we look across a broad universe, and there's a lot of stuff out there. And so you mentioned the client in this example being somebody who has high risk tolerance. I would think that that is suggestive of that client being interested in variable insurance, which allows you to basically take market risk inside an insurance policy with much more discretion over what it is that you're buying. So, for example, with a variable policy, many of the registered products, which are the variable policies that you see kind of out available in the market generally, they come with a list of investments that will look similar to what you might expect if you've ever logged into a 401k account and looked at the menu, or a 529 plan and looked at the menu of investments. The variable policies each have those too. And historically, they're a bastion of high fees. And what's great is that a lot of insurance companies have gotten the message that clients don't want that and don't like that anymore. And so now you can actually buy the S&P 500 inside an insurance policy for a very modest fee, right? It's not quite, say, like the 3 basis points you'll find at Vanguard, but you can get it for 10 basis points or thereabouts, right? It's very low. And so I think for a client like you're describing, where they have high tolerance, they're playing for long-term upside, that variable insurance product could be very interesting to look at. And then there's whole life, that is for sure an option, but whole life really works more similar to a bond portfolio. If you compare whole life to a bond portfolio, it often looks really good. But I think where people can sometimes get disappointed by whole life, and where we try to help our clients understand before making the decision, is that if you buy whole life expecting it to move with the S&P 500, you'd be disappointed, because that's not how the product works. But if you buy whole life expecting it to be like a tax advantage portfolio of fixed income with some interesting guarantees against the downside, that's when you can really be like, wow, this whole life policy is working great for me. I'm happy about this. I like the way this works. So I think that match between what somebody really wants and the right policy for them is super important to get right. And we're very focused on that.
Oh, I think that's so well put. I haven't quite heard it put that way. And again, you can find Wallis Tsai by going to aboveboardfinancial.com/billions, aboveboardfinancial.com/billions. That makes some good sense. Okay. Now you mentioned universal. Is that somewhere in between variable and whole? Is that like a blend, or what's the real difference there?
It's a great question. So you can see universal policies that are also variable. In fact, variable policies are generally also universal, just to make it a little confusing. But one thing to sort of simplify it that's helpful is that whenever you see the word universal, what that usually means is that the policy has some more flexibility in terms of the premiums. And so that can be sometimes be really helpful for the types of strategies you were talking about earlier, where you're putting real assets into a trust. Because, and you can tell me if this is the right assumption, but I would imagine in the scenarios that you're working on yourself, you don't always have perfect clarity on exactly how much you're going to want to put into the insurance policy 5, 10, 15, 20 years from now, right? It might depend on certain things like, does the acquired business perform awesome or well, right? And so there might be some variability. And so sometimes having that flexibility can be super helpful. And then within Universal, and this is where we are laser focused on helping clients understand how things work, you have a lot of different types of universal, right? Sometimes you have indexed universal, other times you have fully guaranteed universal. And indexed universal will track an index like the S&P 500, but importantly, what's going on behind the scenes is completely different from what's going on behind the scenes if you do an S&P 500 investment in a variable policy. And that difference is really critical because the way the index universal life policy works is that you can end up making meaningfully less than the S&P 500 return that you were expecting. And that's because typically with those policies, the carriers allow themselves to change the deal on the insured. And this is where that whole owning the details and like knowing what the documents say is really important. Because if you go into it, for example, saying, hey, look, I know that the cash value of this policy might be subject to these rules that I can't get much visibility on, but I know my death benefit is guaranteed until age 120, and my spouse and I want that for our trust, and we're good. That's ironclad. We want that ironclad death benefit. We're good. That can be a great fit with indexed universal life. But what we sometimes see for people who bought those products other places is that they weren't aware the carrier could change the deal. They weren't aware that in exchange for not being able to lose money if the S&P 500 goes down, they were also giving up not just some upside, but like the right in the future to have the carrier say, you know what, before I told you the most you could earn was 10%, I've decided the most you can earn is 7. And that can happen. So this is what I mean by where insurance can be really great if you use it correctly, knowing how it really works. But people can end up disappointed if they buy something that they don't really understand.
Totally. So let's get real practical here. It sounds like if I'm a good health, higher risk, I want it to track the S&P 500. It sounds like variable is the way to go here, right? And in that scenario, you have less flexibility with the premium. It's going to be more consistent than universal, right? I say that correctly?
With variable, you usually have flexibility. Most
with the premium
are also universal. So
okay.
A common thing is VUL, variable universal life. So it's actually both.
Okay, cool. So you still have flexibility with how much premium you're going to be paying, but it's going to be tied more to the S&P 500. And there's probably less likely of an opportunity for the deal to change on you, right? And assuming you're working with you guys and the right carriers and all those things and all the details, right? And then let's just say they want a $25 million death benefit. And I mean, I know it's just generally speaking, is it $1 million per year? Is it $500,000 per year for 10 years? Like what is the general good rule of thumb for every X amount per year will get X amount of death benefit? We can also use 10 million or 20 million or something, but I'm just trying to get a good, like if someone's budgeting for this and they're like, how much I can go take this somewhere else and go make this money over here. And then the last thing I would say, is there any place where you can more control the investment. Someone just says, I'm not a big S&P 500 person. I want to go into private debt or private equity or private REITs or Bitcoin or something else. Like I'm just not a big fan of just the S&P 500. Certainly not the bonds. Like I don't even want to do that. Right. Give us a little bit of that, more entrepreneurial approach if there is any.
Yeah, sure thing. So the answer to your last question there is that yes, there is, but it has some important things to note about it. There's a subset of variable insurance called private placement life insurance, where you can have much more access to a broader array of asset classes than what you would with a normal. It's called a registered variable policy, and what that really means is that the product itself is registered with the SEC, the Security Exchange Commission. And so that means that there's greater transparency and regulation around that variable registered product. And for most people who've sat in a meeting and been pitched a variable policy, that's what they were seeing. Now, with private placement life insurance, it's also a variable product, but it's really something that is aimed at like the high end of high net worth, because typically for those policies, you're looking at least, say, $5 million of premium, just ballpark. And so that's obviously a very different ticket size than looking to do $100,000 to $300,000 a year for, say, 10 to 20 years. And that $5 million on the private placement life insurance, a standard structure would be paying that in over, say, 4 years, right? So you think about the situation of somebody who's willing to do over $1 million of premium a year for 4 years. That's a subset of the folks who might consider doing 100 to 300 over 10 plus years. So, but what's interesting about the PPLI product is that one, you can do it in a way where there is still a menu of investment choices, but they do have more diversity of asset classes and include the things you were talking about with respect to like private credit. Or two, if you have a wealth manager that you want managing those funds, there are also structures available where you can empower your chosen person to go manage the money independently and handle the management of those funds inside the insurance policy independently, but in accordance with an investment policy statement that the client and the financial advisor have developed together. So yes, there is a way to get outside the universe of registered product, but at least as the industry exists today, it's focused on an ultra high net worth segment.
Okay, that's very well said. Thank you so much for that. Okay, so we are moving. Is there anything pretty good pace here? Good content. I'm curious. Is there anything that I haven't asked you so far that you want to make sure you share, and then we can move to the lightning round?
Yeah, no, I think all these have been great questions. I think that the main thing for people to keep in mind is just really understanding what you own if you already own it, or what you're being pitched if you're sitting in a meeting. And if you feel like it's hard to get clear, straight answers to your questions, go with your gut. Because oftentimes when we meet folks who've made mistakes previously buying insurance elsewhere, oftentimes they report that they kind of felt at the time like, oh, I'm not sure I understand this, but like maybe I'm not supposed to. And the reality is that you should feel empowered and confident, right? Like you might not learn to love the spreadsheet the same way that like I do, and that's okay, right? Not everyone has to like love the spreadsheet analysis, but at a high level, right? Like before you step into any policy, you should understand like, is this thing going to do really well if the S&P crushes it, or is it guaranteed by a really well-rated insurance company, and I'm hoping this thing does better than if I bought a bunch of bonds, right? Like those types of things are, I think, knowable, and a consumer who's been properly counseled will have a sense about those baselines.
Good. And quickly, if someone has already set these things up and is feeling these things and is frustrated, are they able to work with you, Wallis, to maybe convert or merge or adjust, and you go back and you renegotiate or something on their behalf and get them in a more suitable policy? Is that something you can do?
Yes, absolutely. In fact, we have a practice in our business that is not the brokerage where we act as an independent broker and seek to find a policy for a client, but rather is like a detailed review, and it's on a fee for service basis. And the way that we typically work with clients there is that if somebody has something, we ask them to share it via a secure shared folder. We'll take a look, and sometimes it's a movie that I've seen so many times before. I can just open the file and tell you, like, I know what this is. Like, this is what you have, and it's it takes 10 minutes of my time. And if that's the case, I'm happy to just hop on the phone and tell people, like, hey, this is what it is. Like, there's no charge for that. But oftentimes people have things that are much more complicated, or maybe even in extreme cases, the policy is in a position of distress and they're facing uncomfortable questions like, do I want to put $80,000 more into this policy every year for the rest of my life? Or in some cases, like people get these letters about policies their parents bought many years ago, right? Do I want to put in $80,000 every year for the rest of mom's life? She's a healthy 83-year-old. I'm not sure what to do. For those more complicated scenarios that require a lot of analytical heavy lifting, we'll make a fee-for-service proposal that kind of looks like an attorney's proposal might look. But importantly, versus attorneys, I am not a fan of the unlimited hourly billing model. As a customer who likes transparency and clarity on the range of likely outcomes, I'm a big fan of like fixed fee or a range of likely outcomes based on scope. And then we stay in contact as we're going through this adventure together and make sure that no one's ever surprised.
So good. By the way, I'm just curious, what's the most common movie you said? And you're like, oh no, I wish I would have taught. Like, we got to just share that. Like, what's the one where if you could just say, like, someone's listening to this and they're like, oh my gosh, like is there a one or two or the most common? You're like, stop, pause before you sign it. Like, is there something that you want to share on that? Like I wish I would have talked to me a year ago. I wish we talked to Wallis a year ago.
Yeah. So I would say two things. One is that if you're being pitched an individual whole life insurance policy, know that that is oftentimes at least a good idea, sometimes a great idea, but oftentimes it's also not your best idea, not the best thing you can be doing. And we find that sometimes things that are, not inherently bad and in fact, like quite decent to good, but they're so heavily and broadly sold that people end up with these things where it's like, oh man, if you had just done this other thing instead, you would have ended up with like 20% more 15 years from now. And I think if you're being pitched an individual whole life policy, reflect on whether you've really been shown a range of alternative strategies. The second thing I would highlight is understand the guarantees on your death benefit. And if the person you're working with cannot explain clearly what the guarantees are on the policy you have or are considering, that is very concerning, because the guarantees on a death benefit, it's a complex issue, but if you get surprised by it, it can be a horrible feeling. And that example I mentioned earlier, which actually was a real life example where a client whose mom was in their early 80s got a letter saying, you want to pay $80,000 a year or let this thing expire worthless, after she had already paid in like over $250,000 in her younger years, right? Like that problem happens when people don't understand the death benefit guarantee that their policy has, and it can lead to really nasty surprises that just suck money out of a family's balance sheet. And so I think understanding the death benefit guarantee as a secondary point would be important. There can be some good reasons to choose a non-guaranteed or a lightly guaranteed policy, but too often we see policies that are lightly guaranteed where it for sure was not because of a compelling trade-off. It was just a badly designed policy, or I suspect the policy design choice that made the premiums look as low as possible. But the dirty hidden secret was that, hey, if you as an affluent person in your mid 40s live past 85, you might be hosed.
Oh gosh, good.
Yeah.
Very well said. Amazing. Let's go to the lightning round. You ready, Wallis?
Sure.
All right. Knowing what you know now, if you go back to your 20-year-old self, what's the one gold nugget make sure you tell yourself to do?
Know yourself and don't be afraid to lean into the stuff that resonates with you rather than the stuff that other people tell you is amazing.
Fantastic. Number two question. What's the number one book you've recommended or gifted the most in the past year?
Never Enough, which is a parenting book. My kids are 9 and 12, and I highly recommend this book for parents. It talks about the culture of achievement and when it can become toxic. All of us want our kids to do well in life, and I think sometimes that can get twisted into a manifestation that perhaps does not serve the children or, frankly, their parents in the best way possible in growing into being competent, lovely human beings. And so
love it. Never enough. Next question. Number one leadership quote or theme that you strive to live by.
Yeah, I was reading something that referenced a quote by Abraham Lincoln recently about seeking to not basically not lean into moments of strong reactions that are negative, right? Like Lincoln was famous for writing these hot letters and then not actually sending them. And so I think that sometimes that's an important thing to remember, that, you know, people are, I think, in the world generally trying their best. And I think oftentimes the rewards are compounded in life generally if you can find a way to put yourself in the shoes of another and give them the benefit of the doubt. And doesn't mean you have to let go of your own personal boundaries to do that, but just trying to give the benefit of the doubt, or at least have some empathy for them.
Awesome. Next question. What are you most curious about right now?
So I'm turning 46 tomorrow, and I am curious about aging. So actually the book I'm working on currently is by Eric Topol, who's a cardiologist out at Scripps in San Diego, and he's done a ton of research on this topic of healthy aging. And so I'm very curious about this concept of healthy aging. And I've always been kind of interested in fitness, trying my best to, exercise and eat well, but I feel like as I'm moving into the latter part of my 40s, I'm like, I gotta read up on this, right? And the book is called Super Agers, and I saw that title and I was like, that's the goal. I gotta read this.
Awesome. Happy birthday, by the way.
Thank you.
Next question. Number one way you're using Chat GPT or any other AI service.
Yeah, that's a great question. So we actually are using it a lot in our business to empower my colleagues to understand how I would want things handled, and really create a consistent and reliable client experience by empowering my colleagues to work as if we're always kind of sitting together, right? Like when you bring on a new employee, they oftentimes, at least something we do, and I was told to do this by somebody who I respect a lot, but you want to sit with the person and really try to imbue the sense of like, well, how do we do things here? What makes us special? What are the key principles? But as with a lot of things, right, whether it's like exercise or eating or what have you, regular daily practice leads to different and better results than just kind of like an initial sprint, right? And so we've been using AI to spread this knowledge about, well, how would I want it handled? And so making sure that the smart and ethical approach and the client communications are working the way that I want them to, right, across the entire company.
Awesome. Second to last question. How do you best stay ultra healthy and ultra disciplined?
Yeah, so I might have an update for you in a few months after I finish reading the Super Agers book, but I am very consistent about doing some amount of regular exercise. And it's actually been one area of my life where I have successfully overcome perfectionism. In that, as a working mom of young kids, a 30-minute or 45-minute or hour-long workout is not always available. And so I developed this thing in my mind of just saying, 11 minutes is better than zero. Great job. Right. And so I think that through that effort, even when my kids were super young, which frankly was a much harder time to work out than now, right? Because now that they're 9 and 12, they can do stuff on their own, right? They have things they want to do. And I can, do a real workout. But I think that regular exercise helps me stay like connected and centered and focused on just like starting the day on the right foot, staying healthy.
Fantastic. And the last question is our kind of our foundation of our podcast. And by the way, in video and YouTube channel, we're streaming on Capital Gains Tax Resistance podcast and YouTube channel, and also, of course, Build It to Billions. And so, if you haven't subscribed already, please subscribe, rate, review, share this with someone that can encourage today to make a great decision with their insurance needs, especially don't take for granted the disaster prevention, as well as the planning and then just the overall looking at all of your different options before you're making these major decisions, so you don't have any regrets. And so we're gonna wrap it up with this question, Wallis. How do you best practice a stewardship mindset over ownership? Because we believe that's really the key to a lot of what we're trying to do here is just encourage people to make a huge impact beyond just they're part of the legacy, they're part of the generation, right? So the stewardship over ownership mindset. How do you best practice that? And any wisdom for us there before we leave?
So, my dad was actually diagnosed with stage 4 liver cancer last year, and he's been doing remarkably well on treatment. But I think that that jarring moment has really made me reflect on this concept that everyone has a finite amount of time, right? And like, I obviously intellectually see that for what I do, and I'm probably closer to that concept and more in touch with the reality of it just because of my work. But having it hit so close to home, I think really made me realize that what really remains in life at the end of the day is your relationship with the people who are closest to you and the impact that you have on the world and people around you. And so, this idea of wanting to feel like things are better because you were there really motivates me. And I think staying connected to that idea of like, how do I want to spend my time? What do I want my kids to remember about me? Really keeps me focused on thinking about positive impact, and it motivates me.
Wallis, Tsai, it's been more than a pleasure to have you on the show. Thank you for dropping a ton of wisdom here in 45 minutes. We usually only go for about 20, 25, but you had so much great wisdom, and it was so practically and practical to be able to apply. I want to just thank you for being on the show. I want to encourage you to keep using your gifts and talents of basically being able to help come alongside somebody and advocate to make great financial decisions with insurance, with planning. Very honored to be able to spend some time with you here. For our listeners who want to get in touch with you, could you remind them one last time what's the best place for them to find you?
Sure thing. So you can come visit us at www.aboveboardfinancial.com/billions. And that's for listeners of this podcast. Thank you so much for having me. This has been great.
Thanks, Wallis. And I also want to thank all of our listeners for listening to another episode of the Build to Billions podcast, also streaming on the Capital Gains Tax Solutions podcast. Again, we're on this mission to help learn and level up by having amazing guests on the show to be able to glean their wisdom alongside with you, the listener or the viewer, so we can always practice more stewardship over ownership and to build our businesses to billions so we can give more all of it away to help MVPs. I'm Brett Swartz. I appreciate everyone listening or watching out there, and we will talk to you all again soon. Bye now.